Welcome to Livewire Markets and our listed series for 2024. Today I am delighted to be sitting down with Hamish Chamberlayne, the Portfolio Manager and Head of Global Sustainable Equities at Janus Henderson. Hamish, great to have you out here from London. Thanks for joining us.
Pleasure to be here, Hans.
So, this sustainable equity strategy that you run, it's been around for a long time, I think since July 1991, well before those sustainability and ESG megatrends ever caught on in markets. How have you and the team learned over time to balance investment returns and sustainability objectives?
Yes, I think that's a question that sort of goes right to the heart of our investment approach, Hans. And the punchline is that it's not a balance. And ever since I started managing this strategy more than 10 years ago, we've had a very simple mission, which is to show that our approach can deliver better returns than a standard or classical global equity peer group. And we have done that. So over the last decade, we've delivered an annualized return greater than 12%, which has exceeded that of the MSCI World Index. And ultimately, we believe that the transition to a more sustainable global economy is one of the biggest investment opportunities of our lifetimes. So for us, sustainability is our investment strategy. It's how we find some of the most exciting secular growth trends and sort of how we identify some of the most exciting companies that are that we believe are aligned with those trends and going to grow and compound our clients' wealth. So it's for us, it's investment logic. Ultimately, it's all about growing wealth, and we think sustainability is the best way to do that.
So that's one part of it. But the thing is, I mean, Morningstar data revealed recently that the net quarterly outflows for global sustainable funds, that last quarter of 2023, that was the first time on record that we had outflows. Investors withdrawing $2.5 billion US, and then in between the first quarter of 2023 and the fourth quarter of 2022, I should say, inflows in that same survey collapsing by nearly 92% quarter on quarter. So given that ESG or sustainability-focused investing is maybe out of flavor, at least from a flows perspective, how do you as a team handle these situations?
The first thing I'd say is that changing market cycles is nothing new for us. We've been doing this a long time, and we've navigated many different market cycles and different market conditions. And from our perspective, and from our clients' perspective, we have built up a track record of delivering consistent returns. So we have actually sort of maintained our performance over the last 3 years in more challenging market environments. And I'm pleased to say that our AUM hasn't been impacted by the broader sort of industry outflows. We've actually kept on growing our AUM, and we've got the full spectrum of clients, right from pension funds who are at the cutting edge of, shall we say, sustainable investment trends, all the way down to sort of direct investors, sort of direct individual investors and sort of wealth networks. And we've obviously earned a reputation for sort of being able to sort of compound our clients' wealth over time. I actually prefer the fact that the overall industry, shall we say, is a bit less is a bit less frothy at the moment. I actually think valuations are much more interesting when you haven't got huge amounts of capital pouring into sort of sustainable investing markets. So from my perspective as an investor, I actually prefer there being a bit less, shall we say, heat in the market. From our perspective, it's all good. We're very happy to sort of continue navigating these market trends at the moment.
Let's tackle the sustainability part of this. And I'm curious, what are the key things that you look out for to see if companies are truly making that positive impact?
We've got a sort of a very, one of the things I'm proudest of, over the course of my career is that we've developed a very clear and consistent, framework on how to sort of evaluate companies. And our investment process is designed to answer two questions. And so one of those questions is the world a better place because of this company? And the other question is this company going to grow wealth? And so for a company to be included in our portfolio, we have to be able to answer both of those questions. We have to be able to answer the sustainability question, and we have to be able to answer the financial question about growing wealth. And so how do we answer that first question? Is the world going to be a better place because of this company? And that's where we've got some very clear evaluation criteria, both on the positive and on the negative side. So, covering off the negative first, we obviously aren't going to invest in companies that are sort of, doing harm to the, to the world, or companies that are seen as being part of the problem. So, as I'd say with most sustainability strategies, you're not going to find a tobacco company in our portfolio. You're not going to find an oil company in the portfolio. Ultimately, we're looking to invest in companies that are on the right side of some of these big secular trends that are shaping our global economy. And so when we turn to the positive, and in order to evaluate companies and their positive alignment with the transition to a sustainable global economy, we have these 10 sustainable development investment themes. And these themes are really a growth framework. So if I just list them out, I mean, hopefully you'll recognize that companies that are going to be aligned with these themes are probably going to have, greater growth potential. So, going through, we've got 5 environmental themes, such as cleaner energy, water management, efficiency, sustainable transport, and environmental services. And then on the social side, we've got things such as knowledge and technology, safety, health, quality of life, and sustainable property and finance. And so when we look at companies, we're looking for at least 50% revenue alignment with one of our themes. And I think one of the things that we do very well is that we produce very clear reporting. So every quarter, we give our investors the full list of our portfolio. We're completely transparent. And so you can see every holding in our fund, every holding in the portfolio. You can see the thematic analysis and the revenue allocation. And that's something that we've always done, and we've always received very good feedback from our client base around that transparency.
So, Hamish, that's the sustainability part. We'll come to the wealth part in a second, but I'm curious, how do you avoid the greenwashing traps? And I guess following on from that, is it getting harder to avoid those greenwashing traps?
Core to that is the amount of research that we do. And we use a lot of external research providers. So some of these names may well be familiar to the listeners, but obviously we use companies like MSCI, we use Sustainalytics, we use ISS. Being a big organization like Janus Henderson, we've got a lot of resources in order to be able to bring in external research services. We also use companies like Moody's, Vigio Iris, which does very deep, ESG analysis and screening on companies. So, one thing is we've got access to very good external research and I'd say external experts. So we do also tap into non-traditional information networks, talking to industry experts, or even people who work with charities, so we can get another perspective on companies. And then I'd say that links into what we do at Janus Henderson. As a large active management, investment company, we've got a very strong team of both investors and specialist ESG analysts. And our analysts are organized along sector specialist lines. And so we've got some very deep domain expertise, across the firm. And so I think that combination of doing our own fundamental research, and being able to bring in, specialist external resources really helps us to, go, should we say, a little bit deeper on companies and test, and test companies for alignment with our positive, our positive themes.
Yeah, no, absolutely. So let's come to those fundamentals then, and in terms of the growing wealth factor. What fundamental or macro factors do you use to identify those sustainability linked companies that can also produce growing earnings?
Yeah, so I've always spoken about the environmental and social megatrends being our macro framework, really, and I think that just illustrates our long-term approach. So my belief is that the macroeconomic conditions that we experience in the global economy are in part due to the effects of big environmental and social changes that are happening in the global economy, whether that be demographics or whether that be climate change. And our thematic approach, our 10 investment themes, our environmental and social themes, are really how we translate those environmental and social megatrends into investable opportunities. And so for us, it's all about identifying those secular trends, those long-term secular trends, and then thinking about which are the best companies that we can find that are associated with those trends. And if you find good companies and you find good management teams and they're exposed to secular trends, then we're pretty confident we'll be able to deliver some attractive compound growth in returns or wealth.
All right, so provide some proof of that. Tell us about a couple of holdings in the fund, if you'd be so kind.
So I mean, I might tell you about more than a couple quickly, if that's okay. But
Yeah, go for
it'll be
it.
It would be remiss of me not to mention, our two largest positions at the moment, because they have been long-term holdings for us, and I think they sort of illustrate how we can sort of pick up on, companies, sometimes, well in advance of success, and we've sort of got a number of examples of those over the years. We've picked up companies. So, for instance, we used to invest in Tesla in the time frame 2015 to 2021. We invested in Tesla. We picked that one up quite early, and then we divested it because we felt that the valuation got too high. So that was a good sell for us. But two of the biggest holdings in the strategy today are Microsoft, which we've held for, actually we've held for over a decade, or for a decade, so pretty much since I've been managing the strategy. And that's still an extremely high conviction holding for us, because we think of Microsoft as being the world's largest utility. In fact, in the way that we sort of use computers to sort of conduct our business, to communicate, Microsoft is really at the heart of that. And I think of it as analogous to sort of waking up in the morning and turning on the lights and running the tap to brush your teeth, and then ultimately we sit down and switch on our computers. And so it's got a very nice defensive revenue profile, very recurring based revenues. It's like a utility, and yet it's exposed to these fantastic growth opportunities around cloud computing, which we still think has got many years to run in terms of cloud computing. And Microsoft is a decarbonization leader, and that's a really important point. Microsoft is putting itself at the heart of decarbonizing computing, and it's the first company to have announced a carbon negative target. The other company that I'd mention as well, it's one of our largest companies, is Nvidia. And obviously this is a very topical company, but again, we've owned this for many years. And we've always recognized Nvidia as sort of being essentially the next generation computing platform. Well, Nvidia's in our efficiency theme. And one of the key statistics that we came across several years ago was that in the decade from 2010 to 2019, um, there was an eightfold increase in data center traffic globally, or sort of data center usage globally. And over that same time period, global energy consumption by data centers remained flat, completely flat, against an eightfold increase in data center capacity. And one of the reasons for that is that the efficiency, or the power efficiency, of computer chips is just getting more and more, it's just improving. And going back to NVIDIA, when they released the H100 chip, they had a picture of a data center, and there were 25 servers in that data center. And with this new H100 chip, they could take those 25 servers and shrink it down to one server. So basically a 25-fold improvement in power efficiency. And the new chip they announced yesterday, the Blackwell, that does another 25 times improvement in power efficiency. So NVIDIA, because it's really sort of driving the power efficiency of chips, is having an incredible enabling impact on the advancement of artificial intelligence, and doing so, shall we say, at an affordable, shall we say, energy sort of profile.
Terrifying, terrifying. The pace of technological advance of some of these companies. I want to draw on Tesla just for a last question, if I may, because I was going to ask, is there one company that you would love to buy if the price presented itself? Is it Tesla? Maybe is it another company?
We've actually gone a little bit cold on Tesla the last few years, because we do see competition increasing in electric vehicles, and we're actually going through a bit of a lull, I think, in the pace of growth in EVs. We still see it's a very bankable long-term trend, and we've got a lot of companies in the portfolio that are, sort of say, in the EV supply chain. Whether they be semiconductor companies or connector companies, we think it's a bit more bankable to sort of invest in some of these supply chain companies where they've got some strong franchises, some strong technology. In terms of companies that that we really want to buy, so there aren't any companies that we don't own that I want to buy today. However, we do actively manage our position sizes in the portfolio, and we obviously we 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 buy companies with a view to holding them for the long term, but we are sensitive to their valuations, how their valuations will fluctuate around the long-term trend. And so when companies get a bit expensive, but we still like the long-term outlook, we'll sort of bring that back down in position size in the portfolio. And there's one company I sort of highlight which we own, which I'm looking forward to hopefully being able to add back to at some point, and that's S&P Global, which I think some of these data sort of an analytics companies like S&P Global, MSCI, Moody's. I think these are some of the best businesses in the world, because they're incredibly scalable. essentially they're providing data and analytics to people like me, to investors and other capital markets participants. And this data can be sold multiple times. So they've got incredibly attractive margin and free cash flow generation dynamics. And so we sort of see S&P Global as being a very dependable compounder, and it's got a very nice sustainability story as well, because they've really integrated, so shall we say, ESG data and metrics into their sort of their data and analytical services. And if you think about it, these companies have got an incredible impact in terms of how capital is going to be allocated, because investors, governments, corporates, they're all using these data services to inform their investment and capital allocation decisions. And by integrating ESG data into these analytics, it will sort of make people think about sustainability when they're making those investment decisions. So we see a nice sort of, shall we say, growth story associated with the growth in sort of sustainable investing over the long term. So that's a company that I'd highlight.
All right, some great insights there. Hamish Chamberlayne, thank you for joining us from Janus Henderson. And thank you for joining us. If you enjoyed that conversation, please do subscribe to the Livewire Market Index websites, as well as our YouTube channel, where you will be able to catch up with the rest of the 2024 listed series. Thanks for watching.